Welcome back to Look at Business. My name is Simba, Elijah Charles Kiage. We shall be doing episodes of this like a street business every other week right here on Look at Business. Now, for this moment, let's focus on what is really important at this time in the banking industry. Now, this is an introduction for this. Now, the banking industry is setting the stage for what might be a dividend boom this March. After they announced their final year results, this after pre-tax profits for the industry hit 223.7 billion shillings in the period to November 2022. Now, this figure is already 25% above the earnings posted in a similar period in 2021. Today on Look at Business, we analyze the performance of the industry and ask if the stage is then officially set for a bumper harvest from the investors once the dividend season kicks in. And joining us then to analyze exactly where this performance came from, we are joined by the CEO, Miradi Capital, Abraham Muda. The first 11 months of 2022, and that is a stellar performance. But then, Abraham, let me just open this conversation like this. Immediately after 2020, when the rest of the industries was really catching up from the effects of the COVID-19 pandemic, the banks looked as if they started harvesting, and that harvest has not stopped 2 years down the line. Is that a sign that the economy is looking up? But then, Abraham, if you say the economy is looking up, where are we factoring in things like record inflation now that is affecting how the economy is performing?
Okay, generally speaking, in any economy, we are dealing with a zero-sum game. So if somebody who's losing, there's someone who's gaining. Now, I'm not saying that it's the bank that is gaining everything, but yes, I think they're part of the group that is gaining. Now, going back to what you've just said, I think the trend has been upward for several reasons. You remember during the thick of the COVID period, banks took a very heavy hit, especially on provisions. Remember, provisions are just assets you take to just cushion you in case things don't go the way you're supposed to go.
Yes.
Now, and they were very, very prudent in the way they did them. So they took a very heavy hit on their profits, and that's why their profits all dipped. But now, in the years that followed, that 21, a bit of 21, and now 22, they are now fighting those back. That's one of the biggest sources of that improvement.
Yes.
That's number one. Number two, banks have basically three sources of income: main interest income, transactional income, and forex. If you go to interest income, of course, now with the liberalization, the margins between what they're selling money at and what they're buying money at, that gap has widened. So their margin is larger because remember, they're not capped at the top.
Yes.
And also they're at liberty to pay as little as they could. Because previously that other law not only defined how much you could not go above in terms of cost of credit, it also defined what you could not go below in terms of price, the return you give on deposits.
Yes.
Now those two caps have gone. So they're back to what they do. They minimize how much they pay you and they maximize what they charge you. That's one. And now lastly, on the forex front, because of the gradual depreciation of the Kenya shilling, then you tend to have more transactions. People tend to transact more when they believe that the dollar will be more expensive tomorrow, so I want to buy today. So people over-transact more than they would have, because if I know I'll need money in X amount of days, in a stable environment, I'll wait. But when you hear sentiments, you even get in transactions that you would not have gotten to other than if that information was not with you. So what I'm saying is, whatever the economy is going through is playing for the banks. Because if you look at those three transactions, those three income areas, they're all on an upward trend. And now, again, don't forget banks have also really sophisticated in terms of channels. Remember, channels cost less to deploy.
Yes.
So and you've seen there are banks that let people go. Mm-hmm. So as they're rationalizing their expenditure, they're growing their income. So the net result will be obvious. There'll be a boom, and that's what you're seeing now. So to me, that is where I think all this is coming from.
Yes.
Yes.
If you go back to 2020, I mean, it's not just a couple. Majority of the lenders in the country did cancel the dividend payout.
Yes.
Then a year later in 2021, they did improve on it or get back on payment terms. Abraham, 25%, a result that is way above where they were in 2021. Is this a sign that come March this year, when we're going to see the final results for these banks, that we're going to see an improved dividend payout? Or it's just going to be about the same ratio? Because also banks are also saying that, well, the economy is not looking good when you factor in where the inflation rates are currently.
So with dividends, there are two factors.
Yes.
Dividend is a factor of profit. The only limitation is that you cannot pay more than what your net profit after tax. That is what the Companies Act says, that you cannot, of course, you cannot pay what you've not made in terms of profit.
Yes.
So you can literally pay out your entire profit. If your board so wished, there's no limitation to that. But now the other limiting factor is your cash flow. If you just said it was 2021 when most banks cancelled or did not pay out. Why?
Yes.
Because everybody was conserving cash. That time it was consolidation. Let me hold what I have because I do not know how the future looks like. Now the horizon looks a bit better. It looks people are a bit clearer. Yes, the COVID issue is almost behind us. But we are staring at recession. But I tend to think they'll pay out. Why? Because they conserved cash. So banks are awash with cash. Even if you look at the liquidity, most banks, the average is about 40. So that's a very high liquidity ratio, given the statutory one is about 20. So you're sitting on a margin of about 20%. So I think they will pay. So, but of course, subject to those two, or how much they'll make in profit, but more importantly, how much they can afford. But now, again, it's the board to declare. Once they declare it, but they'll declare it with the mind that whatever we are declaring, we can pay.
Pretty much.
Yeah.
Even as we talk about these profits that the banks are getting, we do know that in as early as 2020, some banks had actually been given the green light to get into the risk-based lending model. Abraham, what came out, by the way, from that is that banks even had the leeway to look at you as a borrower or as an institution and say, you belong in this category, so we are going to adjust your interest rates based on your risk profile, because then the Central Bank of Kenya had cleared that particular model. In any way, Abraham, will you look at this 25% and say, if indeed I'm going to look at the top banks, that is Cooperative Equity, National Bank of Kenya, KCB as well, as contributing to 60% of the loan book in the country, essentially also the profits from them, that the risk-based lending model could be behind this result?
Pretty much, because you see, you're looking at rates being bumped from 13, 14
yes,
to 18 to 21. That's happening already. And you're right. Yes, those risk models have already been passed by central bank. And basically what the models will do is that they'll profile you based on certain algorithms and decide that your pricing is X margin above the base rate.
Yes.
So 2 points, 3 points, 6 points, or whatever model they have. But the net sum is that they're charging much more. And if you look at that in percentage-wise, if you look at 18 versus 13, you're way about there. You're about 25% about there. So yes, a good chunk will come from there. But don't forget, even the transaction income has gone up because there are more transactions going on.
Yes.
The forex income has gone up. So the total mass is that everything is going up. But you're right, in terms of the bulk of that money now will be coming from that extra margin, because now, basically, with that model, they don't have a ceiling. It's only that within the model, of course, the model has a ceiling that it can only go to. So the margin can only be up to X, which may be up to 8, up to 9, above whatever the base is. So if the base moves, whatever is on top moves. But the sum total of that. But the flip side is that if you look at the deposit rates, especially for the retail, people below 1 million or people below half a million, there's not much that is paid. So that the arbitrage, if you look at that difference,
yes,
it's massive, and that's where the money is made.
Do you think it's a tough balancing act for majority of the banks who, number one, would only want to go to the people with a good credit score and lend them, and institutions with a good credit score, as opposed to going to institutions and businesses that they deem high risk? Is it a tough balancing act, or that has been left to the purview of the banks to say, well, we have to balance the books and still make a killing out of this model?
You see, and that's where policy comes in. Banks are profit-driven institutions.
Yes.
And it's okay because that's what they were built to do. The investors who put money in them, to make money for themselves. Now that is one objective. The government on the other side is pushing for access to credit, not only access to credit, but access to affordable credit. Now these two goals are at cross purpose, if you look at them very carefully. And the only way they can be brought congruent is if you now not just de-risk the client, their funding, but take out the option. And that's normally the easier one. Take out the option of banks putting their money in government securities. Now, how do you do that? You do that by lowering the rate of the rate that is paid on bonds and on treasury bills. Now, if you look at bonds, for example, the bonds now the infrastructure bond is almost 14% tax-free. If you look at the treasury bills, 7, 8, 9, they're still very attractive because what it means for the bank, they can book that money and go to sleep, and they'll make the money they want to make. But whereas the bank will succeed and make the money they're making, and by the way, this is part of the chunk of the money they're making.
Yes.
The banking per se, the economic effect of a bank in the economy will not be felt. Because what they'll be doing is they'll be taking your deposits and putting them in government. And then government pays, they pay something small and keep a lot for themselves. But in terms of using those deposits to create credit and spur economy, that will be minimal. And this model has worked. Remember, in 2003, 4, 5, when the rates for government securities was pushed down, banks, what did they do? They started hawking loans. Why? Because they had no other option. They already have liabilities of deposits. They have to create assets. The asset they are used to creating is government securities. That has gone below the cost of the funds they're putting in. So what option do they have left is to lend. Now they had to go back and do models of unsecured lending so that they could push out the money. Otherwise, they're also going to go under.
Yes.
So back to how I started, that there's this person who wants to be profitable at whatever cost. There's this government that wants affordable credit for their people. The congruence comes when you take out the option of this bank putting their money in your paper.
The things that we look at when we're looking at the performance of the banks, you've got to look at how much their loan book extended. And it's a lot, because if you look at what majority of the listed lenders in the country closed the lending period with a 3.656 trillion from 3.248 trillion a year before, with a government that is already now at the back of that committed, number one, to cut down on expenditure. In fact, they have a figure, 300 billion to be exact, Abraham, without even looking at this budget policy statement that we do have that is going to guide on exactly how much money the government is going to borrow. Do you think that in the long term then, in a government that looks to cut down on expenditure, that this sure bet source, that is government paper that the banks have been cashing in on heavily, it's going to be less and less as time goes by, therefore forcing that this performance that we're seeing here maybe in the longer term to come down?
The truth of the matter is, yes, if you look at that budget statement, the objective is to slowly move towards balancing your budget.
Yes.
The effect of balancing your budget is that you don't need to borrow. Treasury bills and treasury bonds is government borrowing on the domestic market. So that will go down. And even when they come to the market, they'll come at a rate, they'll dictate the market, because they'll come for very little money and they'll be looking for very low rates, and they'll get them.
Yes.
Because there'll be desperation. But now, what that will do is just what I've said. Banks will have to think, because banks are not going anywhere. They are sitting on liabilities. Now they cannot put it in government paper. They now have to shift and now use the credit, these risk models that they've created, to now go and grow their book, and grow their book substantially. Yes, the book has grown by about, as you say, about 400 billion. But if you look at the need for credit in Kenya, it's in trillions when you think about it. So, and why are banks still sitting on 40% liquidity when they statutorily they are allowed to push it down to 20%? So this buffer, and why there's a buffer, because this buffer mostly represents what they've put in the government paper. Because when you're doing your liquidity return, government securities count for cash. You see, so they win both ways. So I'm telling you, it has to be deliberate by government to bring down, to try and balance their budget. Number one, because that will reduce the need to borrow, and lastly, it will also ensure that credit now has to go to the people, because it's the only viable asset that the banks can put their money in to pay for their liabilities.
Pretty much. Yeah. Let's look at another thing that is quite important when you're gauging the performance of these banks, is the CBR.
Yes.
Now, we do know that it has retained at 8.5%,
yes.
But if you could track it back to 2020, we had the magic 7% that
yes.
really got stuck all the way up to where we are right now. So we look at this 150 basis points that is increased from 2020 to where we are in 2023. In what way would have it affected the bank's performance, Abraham, had the Central Bank of Kenya essentially looked back at it and said, high inflation numbers in the economy is struggling to get out of the holes of the COVID-19 pandemic. Let's retain it at about 7%, because there was a time that we were talking about this 7% for more than 2 years. Do you think that the performance could have been different had the CBR not been adjusted upwards by the Central Bank of Kenya?
Not really, because, worldwide, you're seeing that's what everybody's doing, and it's a monetary policy tool. When the interest rates are high, you push your general interest rate, you push your CBR, okay, for Kenya,
yes,
or your Fed rate if you're in America, up, because
yes,
that is normally the benchmark for the cost of money. When you push up the cost of money, it means that people, instead of keeping money in pocket, they'll put them in instruments. They'll put them in treasury bonds because there's a return. And the whole idea is to reduce the supply of money in the economy, so that we have less of what we call demand push inflation, where people buy because people have a lot of money in their pockets.
Yes.
So it's a way to mop up. But at the same time, it stifles, and while it's at it also stifles credit. How does it do that? Because the cost of credit goes up. Because when you push CBR up, the cost of credit goes up. That means you slow down, because credit creation also means that people again have money in their pocket.
Yes.
But then again, it defeats the same other thing that you're trying to do on the other side. You're trying to create access. So it's a very tight band. And that's why you used to see CBK sometimes would just say, let sleeping logs die, we are leaving it the way it is. Because sometimes it's a very, very tight band. Because on one side, you want to deal with inflation. On one side, you're messing up with credit creation. So it's a question of which one can give up for the other. But it's a thing, that's why you have to keep reviewing. Okay, inflation now is better. Okay, now let's start pushing it downward.
Yes.
And keep adjusting the two. But in tandem with your fiscal policy of trying to balance your budget.
Yes.
Yeah.
Another segment that is quite important when we're looking at the performance of the banks, or used to be important, is this non-interest income. Let's talk about a particular one that is essentially mobile to bank accounts to mobile wallet transfers. This result that we're talking about here, Abraham, come at the back of a time when that was not a thing. It was already stopped by the Central Bank of Kenya. And there was a time at the beginning of this year when it was reinstated, but then somebody rushed to court again to stop them, saying that, well, the reason as why you stopped it is still a factor in the economy. I want to get your sentiments on that as well. If indeed banks can give us this performance, we're talking about 25% more than what they were at this time in 2021. Is there any need for the lenders in the country to come in and say, well, we need to reinstate these charges to transfer money from your bank accounts to your mobile money wallets? And number two, what is your feeling on this particular move then to actually have the banks to stop these charges completely? Because it looks as if that is where the conversation is going to go next.
I hear what you're saying.
Yes.
In anything that you charge or give up, you have to look at what is it that you're gaining and losing.
Yes.
So does the loss, I'm losing 2 shillings, but I'm gaining 3 shillings in something else. In this example, the fact that there were no charges, really, the velocity of money went very high. The velocity of transactions was so much higher that it helped the liquidity in banks.
Yes.
If the banks were to do a proper assessment of, and you see, don't forget, these deposits that are in current accounts, those are not earning any interest. So people are comfortable. I get some money, I throw it in my M-Pesa because I know I can get it out. There's really no transaction fee in and out. If you look at that money that they made based on that buffer of deposits vis-a-vis that period, and vis-a-vis that small transaction they're talking about, if our banks, I would not charge. Because even when they were introduced, you saw things changed. People started asking for cash directly. People started changing because to them, it's punitive as far as they're concerned. For banks, clearly they can live without it. It's very obvious now. They can live without this charge. So I think sometimes when we do charges, I think we need to look at not just the fact that we are growing our transactional income, but what is it that we are losing as we grow that transactional income?
Yes.
Who are we blocking out? Who are we discouraging? Because remember, these are channels. And the freer and cheaper or freer that they are, the more they get used. And people had gotten used to this now. Actually, COVID had really pushed us that direction, where I get money, I put it in the bank, I put it back. So it was easy. But now with those charges, you're like to and fro, no, I will not charge. But to answer you, my personal opinion, I think we should stay the way we are. But again, it is a matter before court. The court may give it back to them. But even the banks, from a perspective of saying, I will not charge, I think it will work. And this is what I think might happen. You might have a split in the middle. Some banks will charge, and some banks might decide not to charge.
Yes.
I think that's what we're going to have. And then now you'll see a skew
yes.
towards those who are not charging. And then eventually everybody will walk away from these charges.
Pretty much. Let's talk about another issue that is really pertinent to the way that the banking industry's outlook is, Abraham. We're starting 2023 at the time when we're talking about finally Equity Bank completing the deal to buy out Spire Bank, setting the stage again for what we've seen in the industry, acquisitions and buyouts. Do you think that 2023 would also then form the basis of this trend?
Tier 1 banks, especially the top 5, Equity, Coop Bank, KCB, NCBA, a bit of Diamond Trust, I think they become very big, and you cannot blame them that they're in business. But you can see the skew. 60-70% of business probably ends by the time you get to the 9th bank.
Yes.
You're about 60-70%. Now, the question is, the Tier 3, have they grown? Yes, they have grown. Have they grown up? I don't know. But they have grown, and they're trying the best they can. But remember, when there's a confidence issue, a lot of deposits also are skewed towards the Tier 1 banks, because people felt safer there. So if you ask me what I think will happen is whatever is going on will just become more in terms of you may have more acquisitions.
Yes.
Like you see what has happened to Spire. What you see, Access tried to get to buy what is it called? I forget the name of the bank, but it fell through. The thing is, either you can recapitalize to a level where your capital is near a Tier 1 bank, you merge with someone, so that because the issue here is capital.
Yes.
Your capital base, because your capital base also allows certain, because they are all controlled or governed, regulated by certain ratios, that your deposits must be a certain factor of your capital. There are certain ratios that you cannot breach. So for you to get on certain things, or even to borrow certain amounts from the market, or even sit on certain deposits, your capital must be at a certain threshold. So I think banks, and being who they are, they probably are quietly doing whatever they need to do in terms of seeing how they can recapitalize, how they can get more capital in through, or who they can talk to come together, or who they can sell to. Those must be quiet, because again, they cannot be done in the glare of depositors for the issues of confidence. So you'll only hear these transactions toward the end. You see, you can see what has happened to Mayfair Bank now. It's fully owned by CIB.
Yes, yes.
CIB is a massive bank in Egypt. Mm-hmm. So I think as we go along, the blur between Tier 1 and other tiers may start becoming blurry.
Yes.
As Tier 2 and 3 banks start coming up. Then maybe within the Tier 1 you may have 2 segments. The bigger, they're all big brothers, but there'll be some bigger ones and the slightly not so big.
Yes.
But then what we want ultimately is to have a situation where any bank, people feel confident that this bank has the adequate capital to take anything that comes its way, even something the magnitude of what just went down with COVID. Mm-hmm. And remember, even if you compare Kenya to South Africa or to Nigeria, our ratio of bank to population, I think we are the best served. So it means probably we may have more banks than we need, but then again, only time will tell. And again, the market always corrects. If the market does not need you, it will kick you out.
Pretty much.
Yes.
So let's talk about, there were fears that the COVID-19 pandemic could have seen us shoot all the way up to 20+%, going by exactly what happened within that period. But then the official figures touched 16, came back to 14%. And they said, well, this is okay, because we've not even shot to 20%. If you look at this period, Abraham, we're talking about 25% increase from where they were in 2021. We're talking about a non-performing ratio of 12.3% in the entire banking industry. It looks as if the sweet spot for the banking industry in the country has been 12 and 14%.
If, let's assume that it is 15% or 14%, if we stressed every balance sheet for every bank, would they all survive? You said that 12, let's cut across. Your ex-bank, if 12% of your book went bad, what will happen to your capital?
Yes.
Will you survive or not? That's the first that needs to be done. And I think it's being done. Secondly, whether that number reflects the truth or not, I think it's very hard to tell. But sentiments are that it could be more, especially during the pandemic. But then again, remember the pandemic, the metrics for measuring what is good and what is bad was altered. And it was altered in broad daylight, because what the CBK did was they said, let's restructure, let's give more leeway. So basically at that period in time, had we applied the original formula, probably that thing would have shot up. But then again, if that was done for prudence, because it meant, I think when they did the stress test, that probably at 20%, probably you may not have, many of the banks would not have survived. Because as per CBK guidelines, you graduate a loan from grade 1 to grade 2, grade 3, grade 4, and 5. By the time you get to grade 3, you have to suspend interest. Grade 4, you have to provide, and grade 5, you have to write off. And there's clear timelines of how you graduate one to another, and that period does not exceed a year. So it meant by within a year, you would have had to take out maybe 30% of your book. How many banks would survive that? So for me, I thought whatever they did was prudent, in that they said, for this period, we cannot use yesterday rules for today, because this is an extraordinary time. So these are the rules for now. Then now that we are slowly going back, those have been adjusted back. And I think that was brilliant, because had we taken a hard stance, maybe we'd be talking a very different story. So for me, in terms of what we need, just stronger banks in terms of capital, very, very, very clear risk models, like that risk model is being passed through the central bank to make sure that it is right. But more importantly, to ensure that the pricing, yes, is as refined as possible, at both ends, at the credit end and at the deposit end.
Pretty much. Yeah. Abraham, always a pleasure speaking to you, man. Look up TV across all your social media platforms. Look up business is the hashtag. I am Akia Gesimba. See you next week.